I sold 80% of my physical silver. I sold it for a little bit different reasons. The silver in my portfolio, physical silver, was different than the physical gold. Physical gold for me is savings and liquidity. The physical silver was a speculative asset. I bought physical silver because it was hated. And I thought that it could run from $20 an ounce to $50 an ounce with the simple dissipation of hate. And I was wrong. It didn't run from 20 to 50, it ran from 20 to 100. A good mistake to make. Suffice it to say, for me, the silver in my portfolio had served its purpose. When the hate dissipated and the price action anticipated, or pardon me, acted out what I had anticipated, the reason for me to own my silver was gone. So I sold my silver. I also thought, which I said at the Vancouver conference, that the silver stocks were becoming a better speculation than silver. And here's the arithmetic there. In Vancouver, I said, if the silver price maintains $75 an ounce for a year, by definition, I don't make any money. If it trades sideways, I don't make any money. But if it maintains $75 an ounce and the valuations of the silver stocks and their earnings are predicated on a $45 silver price, which is what Bay Street and Wall Street are using, there's probably 50% upside in the silver stocks where there's no upside whatsoever in silver. If by contrast, silver keeps running, the silver stocks will at least maintain the pace or outpace it. But if the silver price declines, although the share prices of the companies may decline, given the fact that their net present values are calculated at $45, there's actually more safe leverage to the downside in the silver stocks than there is silver. So for about 50% of the money after tax that I received from the sale of my silver, I bought the high quality silver stocks. We'll talk later about one mistake I made. I also redeployed some of that money into savings, in this case, physical gold. And I maintained some of that money in US dollar cash for deployment.
Well, Rick, I really appreciate you unpacking why you sold some of the silver. Mission accomplished with the objectives, storing some of it in gold for safekeeping, cash for liquidity, and buying the silver stocks for the potential upside as things re-rate from, like you say, a $45 valuation up to maybe a mid 75 valuation. This brings up an interesting point about earnings. We're getting Q4 earnings coming in. The average price for silver sold was around $55, give or take. But when we see Q1 earnings come in, there's going to be a step change because it's averaging, like you say, closer to the mid 70s. Do you think that's really factored in? I mean, obviously you don't, or you wouldn't have bought the silver stocks, but maybe talk about that disconnect because it seems like analysts still haven't caught up with the step change coming. We're almost halfway through Q1 now, and I don't think that they're close to even pricing in this move in silver.
The generalist analysts that I talk to are not. There are some specialist analysts, John Hathaway at Sprott, Dave Iben, who are constructing their own gold and silver earnings forecasts using more recent market quotes. But almost unanimously on the sell side, Bay Street and Wall Street are using $45 silver and $3,200 to $3,500 gold. It's going to be very difficult not to have a surprise when your earnings guides are based on $3,500 gold and you're selling your gold for $5,000. Is there some anticipation? Sure. As I say, you're looking at some very high quality analysts, not generalist analysts, but rather industry specific analysts. And I've named two, Dave Iben and John Hathaway, who have expressed their preference for the market. But the generalist analysts, the people at places, like Fidelity and Vanguard and, those shops are very much behind the curve. And they will be surprised. Over time, too, not just the earnings calculations, but rather the net present value calculations and the future cash flow calculations are based on numbers that are seriously dated. I don't know if that's conservatism. I don't know if it's laziness. I don't know what it is. But if you assume that the $5,000 gold price is going to be maintained, net present value calculations that are predicated on 3,000 or 3,500 are going to be insanely conservative. The difference between that $3,500 per ounce number and the $5,000 per ounce number is all margin. It's important to remember that.
Rick, just curious then, if we are in this environment with these higher metals prices and they stick around, and yes, these projects, when you look at their price to NAV, they seem undervalued. Does that mean that it's going to be another across the board revaluation? Can we get into some of the lower quality stocks or lower quality developers that look better now, but quite frankly, they aren't the tier one assets?
I'm not going to do that. My former mentor and partner, Eric Sprott, that's the part of the market he inhabits. And I guess it's a better speculation than what I do because he's richer than me. What I've decided is that I'm going to give up some of my upside, err on the side of quality, and give up all of my operational downside.
Silver lost nearly 50% of its value in just 3 sessions. Managed money gross longs have been cut by 2/3 since the start of this year. The speculative community was gutted, but price has already recovered 24% from the lows, and the shorts have not covered. They are leaning in. Who is pressured? Those shorts. Every dollar silver rises from here forces the record SLV short position further underwater. The structure suggests we are approaching the acceleration zone where short covering begins feeding on itself. The asymmetry is stark. Speculative longs are at multi-year lows, meaning the fuel for a forced unwind is almost entirely on the short side. Here are 5 signals that are driving silver and gold that we must pay attention to. All right, signal 1. Managed money positioning are at extreme levels, where managed money net longs have collapsed from 45,000 contracts in July to under 5,000. That is 95% reduction in speculative positioning, while price has rallied 135% over that same period. This divergence between price strength and positioning weakness tells us the rally is being driven by physical demand, not paper speculation. That makes it structurally highly durable. Does this increase expansion probability? Yes. Washed out positioning means the fuel for the next leg is short covering, not long liquidation. Here's signal 2, record SLV short interest. The February 20th COT data shows the largest short position in SLV history, building at the exact moment gold breaks above 5,000 to all-time new highs. This is the definition of a positioning against a structural trend. Shorts are betting on a repeat of that January crash. The structure says the opposite is more likely. Does this increase expansion probability? Again, yes. Record shorts create asymmetric squeeze mechanics above 88 to a 92 price point. Now, signal 3, the dollar is breaking down. The DXY has fallen below 98 and is now at 97.5. The Supreme Court striking down the tariffs, followed by Trump escalating to 15% global levies, has created a policy uncertainty that is structurally negative for the dollar. Deutsche Bank warned this week that the dollar's safe haven status is being challenged. When the dollar weakens, the cost of metals and every other currency on earth falls. This draws in global demand. Does this increase expansion probability? Absolutely. Dollar weakness is the tide that lifts all metals. Now on to signal 4. Yields falling toward 3-month lows. The 10-year just printed at the lowest it's been in nearly 3 months. Markets are now pricing in 2 to 3 Fed cuts for 26, up from just a week ago. Falling yields reduce the opportunity costs of holding non-yielding assets like silver and gold. This is the macro tailwind that supports the bid under metals, even on pullback days. So does this increase expansion probability? That too, yes. Lower yields expand the investable case for precious metals. And finally, signal 5, fiscal demand driving the rally. This is the signal mainstream keeps missing. COMEX open interest is flat to declining while price is actually surging. If this were a speculative bubble, open interest would be expanding, and it is not. The Silver Institute has confirmed a 6th consecutive annual structural supply deficit for 2026, with industrial demand consuming 59% of total supply. China's export licensing restrictions that went into effect January 1st are further constraining available metal. This rally is being pulled by fiscal demand, not pushed by a paper bet. Does this increase expansion probability? And again, yes. Fiscal demand creates a floor that speculative selling cannot easily penetrate.